Let's talk about the auspicious occasion today, and that's Akshaya Tritiya. Well, they say all that glitters is not gold, but well, when it comes to investing across asset classes, everything that glitters is certainly gold. Gold has been a timeless metal. It has glittered through crises, wars, and even rate cycles. When uncertainty strikes, equity markets tumble, commodities cool off, and cryptos crack. That's exactly when investors rush to one metal, and that is gold. And it has indeed proven to be a true safe haven. Take a look at this special report on account on the occasion of Akshaya Tritiya today.
As gold continues to hit new highs in 2025, let's decode gold's extraordinary journey. From just $35 per ounce in 1970, gold has now crossed $3,300 per ounce in the global market, implying a 9% CAGR over the last 55 years. Gold's long-term story has been all about preservation of wealth, especially during uncertain times. In fact, the price return of the yellow metal has been at par with Nifty over the last 10 years, clocking an 11% CAGR, and even over the last 20 years, it is not far behind. Here's a fun fact for you. Back in 1990, 1 kg gold was enough to buy a Maruti 800 car. In 2005, the same gold could buy you an Innova. And guess what? In 2025, 1 kg of gold can get you a luxury BMW or an Audi. But will the price surge continue the way it has over the last 50 years? That, of course, only time will tell. So what's fueling the surge? Geopolitical tensions from Ukraine to the Middle East are lifting safe haven demand. Central banks globally continue to buy the yellow metal. Countries like China and India are steadily adding to their gold reserves. Negative real yields and inflation worries are also turning investors towards hard assets. Whether it's inflation, currency debasement, or geopolitical flashpoints, gold has always stood the test of time. But even when it comes to silver, price return profile has been equally overwhelming. ETF inflows in gold too continue to surge. Gold ETFs saw an inflow of 226.5 metric tons worth $21.1 billion in the first quarter of FY25, the largest amount since the first quarter of 2022. The active start of the year follows a modest net inflow to gold inflows in 2024 after 3 years of outflows caused by high interest rates. But while investors cheer the rally, it's the government of India that's now facing the heat, courtesy sovereign gold bonds that it has been issuing since November 2015. Gold prices have nearly tripled since then, and reports suggest government's liabilities under these schemes have now reached 1.2 trillion rupees. But has the surge in gold prices impacted demand? It certainly has. Jewelers Association says consumption demand fell by 8% in volume terms this wedding season. But on the flip side, investment demand has seen a steady uptick, driven largely by recency bias or FOMO, as we may call it.
As of now, the demand is slow by 8% in weight terms. So last year, if we had a demand of, let's say, 200 ton during the season, so this year we may see it around 180 tons or 182 tons. But if we talk in terms of money or in terms of value, then we are up by a 10 to 12%. So I don't see that the major impact on the demand has happened due to the higher prices. In fact, the people, those who sold because of the news that the gold is going to come down at 56,000, they are coming back to buy their gold.
As gold continues to dazzle on the charts, the question remains, is this the peak or just another pause before the next leg higher? Although gold has fallen nearly 6% from its record of $3,500 per ounce amid signs of easing trade tensions, brokerage houses continue to remain bullish. But whether you are a cautious investor or a market watcher, one thing is for sure, gold will always be worth its weight.